Welcome back to the deep dive. Today, we were taking a scalpel to one of the most polarizing earnings calls of the quarter, the Q3 2025 results for Inuvo Inc., the ad tech player you'll know by its ticker, INUV.
And we really have to call this one a deep dive because, look, it's a classic study in divergence. The call was after hours, November 6th, and the market reaction was just brutal. The stock dropped nearly 9%.
A drop like that, that usually screams major demand disaster.
It does. But then you listen to what management was actually saying and you hear this whole counter-narrative, a story about a deliberate strategic move.
A necessary sacrifice, they'd say. So our mission today is to unpack that split for you. Was Q3 really evidence of some deep structural weakness?
Or was it just the cost of doing business? The price they had to pay to transition their AI, IntentKey, into something much bigger and, well, more valuable in the long term.
Exactly. Let's find the truth hidden between the line items and the C-suite spin.
Okay, so let's start where the market panic did. The quantitative miss.
The headline numbers, what were they?
The revenue number was $22.6 million. And while, that was a slight 1% increase year over year, the real issue was it landed about $3.3 million below what the street was expecting.
That's a meaningful shortfall. That's the kind of thing that spooks investors right away.
It does. And the earnings didn't help either. The GAAP net loss, well, it narrowed a little bit from negative 15 cents a share last year to negative 12 cents this year.
But it still missed. The consensus was looking for negative 8 cents, so a top-line miss and a bigger loss than expected. But there was one number that really shocked people.
Oh, yeah. The margin compression. This is the one. Gross margin fell off a cliff. It went from a really impressive 88.4% last year all the way down to 73.4% this quarter.
Whoa.
You're looking at a 1,500 basis point decrease. That kind of drop, it just screams trouble.
1,500 basis points is massive, so we have to stop and ask, how did they explain that? Was this some kind of sudden collapse in their operations?
No, and that's the key. It wasn't a collapse in pricing power or anything like that. It was an operational mix shift, all tied to their new largest platform client.
Okay, so what does that mean in plain English?
For this one huge client, the media costs are accounted for in the cost of revenue. Historically, those costs for a lot of campaigns were listed way down in operating expenses.
And why does that accounting difference matter so much for the margin percentage?
Well, gross margin is just revenue minus your cost of revenue. So if you suddenly shift millions of dollars in media spend up into the cost of revenue bucket, you inflate that number and the margin percentage just tanks.
Ah, I see. So it looks terrible on paper, but it's more of an accounting headwind than a profit crisis.
Exactly. Visually, it hammered investor sentiment. But to be fair, compounding that visual hit was the fact that the adjusted EBITDA loss did get a bit wider to about $0.7 million.
Okay, that makes sense. The market reacted to the visible pain, not the underlying accounting nuance. So let's pivot to management's defense, because they were adamant that the revenue miss was not a failure.
Not a failure of demand, no. This was the key narrative. They stressed that the shortfall was tied to a mid-August decision to pull back, to throttle ad spend for their single largest platform client.
They slowed down their biggest revenue driver on purpose.
They did. All to implement a major compliance and quality upgrade. The CEO put it perfectly. He said Q3 performance was, and I'm quoting here, not a function of reduced demand, but of preparation required to onboard demand.
So they chose to build the foundation instead of taking the immediate cash. That's a bold move, a really high-risk one. You intentionally slow down your biggest client, you risk them just walking away.
A huge risk. So you have to ask, what did they build that was worth it?
Right. What was it?
They built something called Ranger. It's an AI-driven system, and it's focused squarely on risk mitigation. Its whole purpose is to make sure every single ad creative is fully compliant and perfectly aligned with the landing page.
So it's an insurance policy.
It's an essential insurance policy against getting blacklisted by Google or the big TV platforms. In this post-cookie world, quality is everything. One wrong move, and you can get cut off completely. It's a critical differentiator.
And was the sacrifice temporary? Did they get that client back up to speed?
They did. They confirmed platform revenue in October was already back to year-over-year growth. The system is in, and the brakes are off.
That's a strong sign. And while all that drama was happening on the platform side, what about their other segments? The higher margin business?
That was the clear bright spot. The agencies and brands revenue grew 7% year over year. That was boosted by a lot of healthcare campaigns, open enrollment. But the real story is their self-serve platform.
Using IntentKey.
Right. They have 44 self-serve brands on there now, and these are generating contribution margins of around 90%.
90%. Now, that's the kind of high-quality revenue stream you want to see.
Absolutely. And Ranger is just one piece of the tech puzzle. They also rolled out some big enhancements to IntentKey and a whole new visualization tool.
IntentPath.
IntentPath, right. And this thing is powerful. It uses their own proprietary large language model, their LLM.
We hear LLM thrown around constantly now. What's it actually doing here? It's not writing ad copy, is it?
No. It's for data processing. Because IntentKey doesn't use cookies, it generates this huge amount of unique behavioral data. IntentPath uses the LLM to process all that and map the audience journey.
From just being aware of a product all the way to buying it.
All the way to conversion. It turns abstract data into a clear visual pathway. It moves IntentKey from being just a tactical ad tool to a strategic planning tool for the C-suite.
And that's a perfect bridge to the leadership shift, because if you want to sell strategic tools to the C-suite, you need a different kind of salesperson.
Which brings us to Rob Buchner's promotion to COO. This might be the most critical development they talked about. His background. I mean, he was a former agency CEO and CMO at powerhouses like Publicis and IPG.
So they're bringing in a heavy hitter. What's his mandate? It's what they're calling an upstream strategy. The goal is to move away from relying on a few potentially volatile platform clients and instead go after those multi-million-dollar brand direct deals.
Using IntentKey for the big picture stuff like media mix modeling.
Exactly. And Buchner's the guy who can get them in the door. He knows how those brands operate. And they gave him some serious ammo to work with.
You're talking about those performance metrics, the independent analysis.
I am. 20 to 40% higher efficiency than the old ID-based solutions. But here's the number that makes you sit up straight. They claimed incremental returns of 400 to 600% on TV and display ads.
400 to 600%. I mean, come on. A skeptic has to ask, how is that even possible? How do you verify a number like that?
And that's the right question. Was it a small test campaign? Were the control groups perfect? They didn't detail the methodology on the call, but the sheer boldness of saying it suggests they're pretty confident. They're betting their whole new strategy on that number.
Okay, so they have the tech, they have the new leadership, but they need runway. Let's talk about the balance sheet catalysts, because these are absolutely critical to de-risking this whole transition.
Right. They're sitting on at least 2 pending multi-million-dollar cash infusions.
First up is a big U.S. government contract.
Yep, a multi-million-dollar one. It got delayed by the government shutdown. So it's a logistical delay, not a rejection, but it pushes the cash out a bit.
It's the ultimate irony, isn't it? The company pauses to work on its own internal compliance, and then the lifeline cash is held up by political bureaucracy.
You can't make it up. But the second one is maybe more certain. It's a large class action lawsuit settlement. And critically, Inuvo is the plaintiff.
So this is cash coming in.
Cash coming in, not going out. Management explicitly confirmed they expect a substantial multi-million-dollar inflow in the first quarter of 2026.
Okay, so let's connect this back to guidance. Despite the Q3 mess, they're still feeling good about the full year.
They are. Year-to-date revenue through Q3 is $71.9 million. That's up a solid 25% year over year. And they reiterated confidence, saying Q4 will be their strongest quarter. If they hit that, they believe they'll be near $100 million in trailing 12-month revenue.
That confidence runs right up against the immediate financial reality, though. Let's talk liquidity. They closed the quarter with only $3.4 million in cash.
And they'd already drawn $3.4 million on their $10 million credit facility.
Yeah.
The runway looks incredibly tight.
It does.
And that's exactly why the stock is so volatile. The market is pricing in execution risk plus liquidity risk. It means those catalysts, the lawsuit payout, and the government contract aren't just nice-to-haves. They're absolutely critical life support.
But the strategy itself, focusing on AI-driven tech in a privacy-focused world, that seems sound, doesn't it?
Oh, it's the right place to be. Digital ad spending is still growing. Legacy agencies are struggling. The problem isn't the idea. It's the execution and the financial cushion. The stock is down 55% year-to-date, which tells you investors are valuing the risk over the growth story right now.
That volatility and the specific timeline of these cash infusions, it sets up a pretty unique situation. Which brings us to our segment where we outline an outrageous but plausible trade idea based specifically on the details from this call. And as always, this is purely for discussion. It is not financial advice. Please do your own homework.
Okay, so we're calling this the compliance cash flow corridor strategy.
I like it.
The market has reacted as if the Q3 miss was just a simple demand failure. But it's ignoring these two specific multi-million-dollar cash events that have a high degree of certainty. They're being underpriced because they fall just outside the immediate quarter.
So the idea is to focus on the de-risking effect of this deferred cash.
Precisely. That guaranteed cash inflow from the lawsuit in Q1 2026 is the key. With only $3.4 million in cash right now, that settlement acts like a deferred equity financing, but without diluting shareholders. It solves the immediate liquidity problem.
So what's the rationale for the trade?
You assume the government contract also signs in early 2026. Those two events could easily double the company's cash position and pay down the credit facility. That immediately reduces the liquidity risk the market is punishing them for.
So the trade is a long position.
It's a long position betting on successful Q4 execution combined with the market realizing these cash catalysts are coming. If the liquidity fears go away, the stock can finally trade based on its underlying 25% growth and that 90% margin business they're scaling. It could allow for a pretty significant valuation correction.
Okay, so if we put a bow on all of this, what's the final takeaway?
Q3 2025 was a truly mixed bag. I mean, quantitatively, the revenue and margin miss sparked a panic. But qualitatively, the quarter was strategically powerful. They were fixing the plumbing with Ranger to go after bigger contracts with Rob Buchner.
So the big question for anyone looking at this is whether Q3 was that necessary temporary pain you have to go through to transition from being a volatile vendor
to a scaled AI platform that can win those huge brand deals. Or, on the flip side, was it the start of a much longer, more difficult reset?
And the answer?
The answer is going to be all about execution over the next 6 months. It hinges on them winning those big contracts and getting that cash in the door from the lawsuit and the government deal. If they do that, the tech's performance advantages might finally translate into real, durable growth.
That's it for this deep dive. We'd encourage you to look deeper into the dynamics of ad tech compliance and just how these proprietary LLMs are transforming media planning. We'll see you next time.